Be bold about it. You have not because you ask not. If you have a question about becoming your own banker, let me know. Put it down in the comment section below. Or feel free to send it right to me through our contact information. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. We're back today for another installment of our question and answer series where I address your questions on the infinite banking concept and how to become your own banker. Let's dive right in. Ray asks, have you heard about these bank failures? How would that look with a policy without a bank? So that's a great question. We're starting off with this question because this is current news. And I say it's current news. It's not current news. There have been runs on banks and bank failures and government intervention for years and years and years, decades and decades and decades. I mean, go back to the Great Recession. I mean, go further if you want to, but go all the way back to the Great Depression. Excuse me. Yes, we've had the Great Recession since, and same things were happening. So it's not new, but I will address this. This was with a prospective client. The conversation tends to change when folks are clients and they're already doing infinite banking. But I want to answer this for everyone. And I've actually recently done an episode on the current bank failures of 2023. And of course, it looks like there are more. I actually didn't rush right to do an episode on that because, again, things are different when you are already on the journey of becoming your own banker. But we're still also trying to spread the news still about becoming your own banker. So let's address this question that Ray had now. Number one, have I heard about the bank failures? Yes, absolutely. Of course, I've heard about them. And then number two, so what does that look like with a policy if there were not a bank? Well, the answer there, I think, on a big level is there always is going to be banking. Banking is just a function, a process. And yes, there are bank buildings, of course, in my town, just like there are in your town. And there have been some to go out of business in my town. Check into your town, okay? So banks have gone out of business in my town. They probably have in yours as well. So that just means you go to another bank. If you're looking to get a check cashed, which is what this one really was, and to be able to do your online banking or have your direct deposits or what have you. Of course, on this channel, we talk about that key principle from Nash, his fourth principle of don't do business with banks. You know, we're here to promote the idea that you can become your own banker. Don't do business with banks. But banking has always existed. I mean, if you go back in scripture, you can read where Jesus was overthrowing money tables. So there was money being exchanged. There was banking taking place. He even spoke in a parable about the banking function, the parable of the talent. So banking has existed. It's going to continue to exist. The interesting thing is the difference between what commercial banks have done and what their history looks like versus these mutual life insurance companies that have just gone right on ticking. You know, we own multiple policies with mutual companies that have not only been staying in business and paying out all the death claims for well over 100 years, but they've paid dividends for 100 consecutive years. So very, very different. This was early on in a conversation with Ray, and I hope that it's been helpful here for everyone about yes, recognizing what's going on out in the conventional, commercial, financial system of slavery and beginning to learn what it can be like when you become your own banker for yourself. So I hope that has been helpful for you. I still have checking accounts, saving accounts at the commercial bank, and I tell them to send my money to these mutual life insurance companies that I own policies from. And when I make policy loans, they send it wire transfer or direct deposit to my local bank for me to use and whatever it is that I'm using it for. So I use commercial banks. I just don't do business with commercial banks. And if one goes out of business, I just go to another. I mean, if we walk that scenario out so far to where we're talking about complete and entire abolishment of the dollar or commercial banks altogether, there's not a single bank open anywhere. It's a different kind of a conversation that we would be having. And I actually have done an episode on financial preparedness. I would encourage you to check that one out and see if that's not helpful. But thank you, Ray, for that question. That's a good one. And it's on all of our minds, so I'm happy to address it today. Roxanne asks, I'm uninsurable due to health. How can I do infinite banking? Great question. And I did answer that to Roxanne, but if you haven't heard me answer a question similar to that, I would like to now for everyone, that if you are indeed verifiably uninsurable, that's not just you guessing on your health, but you know that you've been refused as a company. Due to those reasons, it may be possible that at some point in the future that you're eligible to reapply. That may be the case. It may not be the case. So again, in general, I'm going to encourage everyone to be as healthy as we can be. Let's be as healthy as we can be. Be that as it may, banking still takes place. And if you want to become your own banker, you need to begin to evaluate and let us have a conversation about who you have an insurable interest on. My wife and I, for example, we own policies on each of our children. And that was actually the case with Roxanne. She had a son that she and I were talking about what that could look like for her to begin banking, having a policy on her son. For her, but here for everyone, that could be a business partner, it could be a family member. So the policy doesn't have to be on your body, and yet you can be the owner of the policy. So you could pay the premiums, you can have the ownership of the policy, control that policy, but it just be on someone else's body, a healthier body. And Nash, of course, covers this in his book, Becoming Your Own Banker. So I'd encourage you to revisit his book. But great question. You can still become your own banker. And having a conversation like Miss Roxanne and I were able to have makes all the difference. Makes all the difference. Someone getting exposed to this idea and being animated about it, but then hitting a roadblock or an impediment at least of finding out that they may not be insurable themselves. It doesn't mean that the educations in their family, the vehicles in their family, the vacations that they take, those are all still going to be financed one way or another. So I would encourage you, of course, to be resourceful, and let's have a conversation about your particular financial situation if you're looking to implement this concept, even if you yourself are uninsurable. So thank you, Miss Roxanne, for that question. Jim's question is, what is the rate of compounding in a policy? Great question. That's another question from our onboarding process where we're going through the education on this concept of becoming your own banker and talking about folks' individual situations. And Jim's question is, of course, a common one. In the conventional financial world, we're taught to focus on, and Nash addresses this in his book, we're taught to focus on rates of return. What's my return on my investing? You know, here the word is compounding, but that's really what's being asked. And I'm glad that the word compounding was used. I've done particular episodes here on compounding, and I think the visuals that I use were really helpful for me, of course. If you've not seen or heard of us give the penny a day versus $1 million scenario, I would encourage you, and I'll put information up here where you can check that out quickly. It's really neat. But compounding, yes, takes place in a policy. So I think that's something that we shouldn't gloss over. Compounding on our capital can take place for the rest of our whole life. Again, I do like that play on words. So for our whole life, we can have compounding on our capital by owning and using properly structured whole life policies with mutual companies that pay dividends. But I know everybody wants to get to a number. But again, I just don't want to overlook, this is not a roller coaster ride. This is not up and down. It's like you can have compounding forever on your capital for the whole rest of your life. That's amazing. Uninterrupted compound interest. It's so powerful. But we want to get to a number. We want to know what that internal rate of return or what that return on our investment. And when I say return on investment, that's just propaganda from the conventional financial world. Life insurance is not an investment. It's life insurance. It's mitigating risk for financial loss. But I'm not trying to sidestep the question of what is the rate of compounding. When you have a contract, it'll have an illustration. And the illustration is just that. It is an illustration. It does not reflect what it looks like for you to use a policy for the banking function in your life. It doesn't reflect that. But again, you see that there's a compounding that takes place. Your death benefit goes up. Your cash value goes up. And it keeps going up. It must keep going up over your whole life. So you could use some third grade math and do a simple calculation on your contract, and before you ever own a contract. But again, you're going to go through an application process. You're going to go through an underwriting, a health screening, etc., to be able to see that for yourself. So when someone's in the process, I don't know whether they're going to be offered a policy from a company yet. That's what the application process is for. That's what the medical underwriting and screening is for. And when we do get to the company offering you a policy, we go through that together. So I'm not avoiding the question. It has its proper time and placement in the process, though. And the biggest point that I would point out is, like, number one, again, compound interest for the rest of your life. When you wrap your mind around that, the number matters, but it doesn't matter. Especially because of number two, which is if you use a policy for the banking function in your life and you begin recapturing interest dollars that were otherwise going elsewhere, and you add that to the compounding that's taking place on your capital just because of the nature of a properly structured policy with a mutual company where you earn dividends, it's incredible. So great question on compounding in a policy. And I'm glad you and I, Jim, got to talk about that. And here, for the benefit of everyone else, we got to elaborate on that a little more. For the record, anytime that I use the name John, it could just mean John Doe. But John asked the question, who do you use for IBC, meaning company, and which whole life product? So sometimes I will get calls or messages, questions, whatever, emails from other professionals that are exposed to this idea of becoming your own banker, infinite banking, and I love it. I'm always grateful for an opportunity to tell anybody to go and pick up Becoming Your Own Banker by R. Nelson Nash and read about how you could become your own banker. I've had phone calls with individuals that are working with captive companies, but they're learning about this idea and they want to know what they can learn for their own selves about implementing this process. So again, I'm grateful for every opportunity that I have to speak with anybody, whether they will be a client or not, because I know that they're going to leave better off if they do begin a journey of becoming their own banker. And of course, if they are a client, then I'm very happy about that as well. To have an opportunity to work with folks that are interested in becoming their own banker, regardless of what they do professionally. So when I got this question, I gave, of course, a private answer, but I don't mind addressing that here on the channel for anybody else that's interested in what I would say there, because I speak about it a lot. So here we go again. Who do I use? Let me tell what I would like to about my own self. Personally, I, Jesse Durham, own whole life policies with different various mutual life insurance companies, but they are all companies that are mutual life insurance companies. They are at least 100 years old. They've also paid dividends for a minimum of 100 years. Some of them are direct recognition. Some of them are non-direct recognition. If you don't know what that means, it just means how they treat dividends and how they award dividends based off of your loan status. And I love them both. I have my preference towards a non-direct recognition company. I do. But my oldest policy, for example, is a direct recognition company that loves IBC. Also, and that's a big deal. These are companies that they may even have their agents or their home office personnel read Nelson's book. So my favorite policy is my oldest one. It's with a direct recognition company, but it's my oldest one. Great company, great customer service, great track record. My money compounds. I access policy loans. I love it. It's my favorite one. So so that's me personally. Who do I use professionally? Same answer. Various companies. No, I'm not married to one company. I've adopted that saying from James Nethery. I should give credit there. I say it often enough because I am married to my wife. I'm not married to any of these companies. I personally own policies with different companies and represent different companies. And then also, therefore, represent different products. Now, I do one thing, me personally, I do one thing. I write I write policies for folks that want to become their own banker. That's it. Maybe it'll change. I doubt it, but maybe it'll change. I don't want to have the arrival syndrome hit me and say that I won't. I'm leaving the door open. But for years, and I don't anticipate that it would change, I just do this one thing when it comes to insurance, because Nash addressed universal life insurance, variable, index, etc. He addresses that. He didn't own any of those, and he didn't write any of that kind of a business. I don't own any of those, and I don't write any of that kind of business. And I told Mr. John Doe that. Okay, but again, I was thankful to have an opportunity to discuss with somebody who's already doing something in their professional space in the insurance industry, to be able to get them an answer for their own selves. And if that impacts them, I'm happy. If that impacts how they do business, I'm happy. It's a good word. It's a good news that I have to spread, the idea that you can become your own banker. So the answer is which whole life product? That depends on the client. Which company? That depends on the client. These companies, they have some differences, and it's good to know what those differences are, and to be able to take an educated consumer with an educated professional and come to an educated conclusion on what is best for that client. So I hope that answer is helpful. I've enjoyed being able to share that with you folks, a bit about my background, my experience, my thinking on which companies and why. And with my clients, I will talk about which companies and why. We talk about that in our process, and which product and why. Because again, when you have an educated client, an educated professional, you can come to a better educated conclusion. And it should just become apparent. I do believe in the philosophy that Nash says when he says in his book, when you know what's going on, you'll know what to do. And that's where I come from. So thank you, Mr. John Doe, for reaching out to me. I appreciate that and asking that question. I hope you found your answer helpful, and that everybody else benefits here from the conversation as well. Sean asks, can I use money from my policy for a loan for a car for a family member? Great question. And I love, especially when the conversation goes in the direction of, well, not just about how I use policies and my cash value in becoming my own banker, because Nash talks about that. Nash talks about it with his grocery store example. You wouldn't be the only person to go into your grocery store. It should be for others, of course. So Sean was talking about, well, if I have a family member that needs to get a car, can I take a policy loan to let them get the car that they want, and I hold the loan? And we talked about that, but again, here for everyone, the more money you can keep in the family, the better off you are. Nash's number one principle to have success with the infinite banking concept is think long range. Think long range. And when he was talking about thinking long range, he was talking about thinking and acting and implementing intergenerational plans. Okay, so this was a sibling to another sibling, which I love. That's a starting point. Okay, when you can think beyond yourself and you think about those next closest folks in your family and how to keep more money in the family and how to do family banking, that's just a natural first step. No question about it. So the answer is yes. The answer is yes. You can use your capital how you want. When you make a policy loan, the insurance company just asks, well, okay, Sean, how much of what's available do you want us to send? And where do you want us to send it to? They don't know if you're going to, or care if you're going to go on vacation with that, if you're going to buy some asset with that, if you're going to finance your own car or finance a car for somebody else. Okay? But being an honest banker, of course, set that up with that family member. Do everything that you should do properly according. And I'm not a lawyer. This isn't tax advice. This isn't financial advice. Okay. I'm encouraging you to do what you want with your capital and to be an honest banker while you do it. Pay that back and pay it back with a market rate of interest. Market rate of interest. If they would have paid such and such percent elsewhere, why not in the family? Where does it go? In the family. That's just more money back in the family. And when you do think intergenerationally, what does it look like if one generation decides to not just buy cars, but buy cars and get the money back? What does that look like for the next generations? Aren't they probably going to be the beneficiaries on these policies anyway? Okay, so and that number is just going to be bigger because you are recapturing interest that otherwise would have gone to someone else. But now that's in the family as well. And if the family, because of that one generation, is going about the business of acquiring these appreciating assets, these properly structured whole life policies with mutual companies that pay dividends, and you're recapturing interest because you're accounting for the banking function in your life and you're just growing that and scaling that, I mean, what could that look like for the next generations? Incredible. And then, of course, there's eventually going to be a tax-free windfall of death benefit to the beneficiaries. And that's where Nash says that's when there is a self-sufficient system. See, when you're thinking long range and you're thinking about, well, when one or two or something like that of these policies, because there should be a system of policies over the course of your lifetime, when one or two of those pays out, doesn't that give a tax-free windfall of money to create a self-sufficient system from that point forward? Talk about expediting your family banking. So we had a great conversation about that, Sean and I. Again, here, I put it out here for the benefit of everyone. Thanks, Sean, for that question. Deb has a question, and this is really good because it does follow up on the one I just addressed about financing vehicles in a family. So Deb asks, my family and I are all doing real estate investment. My son has a second home. My daughter has a second home. We're all doing real estate on the side. Can we fund a policy together? So Deb's question in particular is about funding a policy together. So here, my encouragement is going to be that everyone involved consider for their own selves, do they have adequate protection and coverage on themselves? Just because we focus and concentrate on cash value and building up a private system of policies for financing doesn't mean we should disregard our responsibilities, our financial responsibilities to have adequate coverage and protection. That's worth noting for every individual involved. These sons, daughters, parents, grandparents, etc. Deb was a grandparent. Everybody should have protection in place. Now, at the same time, if you have a properly structured policy, you can have a policy that you are using for your real estate investing, if that's what you're wanting to use it for, of course, because you're your own banker, you're making that choice and decision. So you can address your need of protection. You can also address your need of finance at the same time. And if you as an individual or as a collective family unit are going about doing real estate investing together, I mean, I still presume that the second home, of a daughter is in her name and that the son's second home is in his name, and whether they're going to fix and flip those or rent those, whatever that real estate investing looks like, someone still owns that. So someone as an individual should perhaps still own a policy as well, both to give the protection that in the event that you are doing something together and someone passes early, you have a tax-free windfall of money that will cover anything that needs liquid capital accessible right away to take care of any unfinished business or ongoing business or what have you. So again, this doesn't constitute advice. I'm just having a conversation about my thoughts here on this particular question. And you want to have the protection in place. But of course, if you're doing business together, yes, of course it makes sense. And that's why Deb was asking this question of becoming your own banker so that you are accounting for the financing of what it is that you're doing as individuals or as a family. That way you're even that much more profitable. But also you have the control and the ownership over the financing of the things that you're doing. I mean, when you do sell a home or you do collect rent, you're cash flowing a property, where do you think you should warehouse that wealth? In the commercial bank, the ones that are going bankrupt, or in a privatized banking system that you own and control. So specifically on the point of funding, I'm building up to that. Everybody should have adequate coverage. Everybody should be accounting privately, individually, for their need of finance in life. And then can you get creative with funding policies, with what you do with policy loans within the collective family unit? Oh yes. Lots of interesting things. And that's its own conversation for sure. But with a policy, there is going to be an owner on a policy. There's going to be a payer on the policy. There's going to be a beneficiary. There's going to be an insured. Okay, so a body. And some of those positions may be the same person. Like I have a policy on my body, and I am the owner of it, and I am the payer of it, but someone else my wife is the beneficiary of my policy. But also, my wife and I own policies on our children. We're still the owner. They're minors at this time. So, but that's the relationship. So when you do talk about funding a policy, somebody's going to be an owner. Somebody's going to be a payer. So it's its own conversation for each individual is the real answer. And that's why it's so important to speak with a knowledgeable and experienced professional who's actually doing infinite banking themselves. And maybe somebody who's also doing infinite banking with family members and has been on this journey of privatizing business and investments and things that are just done as a family, financing family vacations, financing a sibling's wedding, whatever the case may be. It behooves you to talk with somebody that has actually implemented this process in their own lives. Never fear, I happen to know a guy. But thanks, Deb, for the question. Pete has a question about premiums for policies on his sons and how much premium that can be. So yes, Pete, there is a difference in paying premiums on children's policies versus the parents or grandparents. For one, it would matter if those children are adults or if they're still minors. For sure, I have all minor children right now myself. Their process is more expedited than an adult's. In general, it's that way for children, that there's a more expedited process for approval, and the sooner the better, of course, just because of health issues that may arise later but have not yet. So that's nice to know. But in general, yes, children are going to be allowed a coverage maybe equal to, but probably a portion of the parents' coverage. So if a parent is covered for a certain amount, it's very common for a child to be insured up to half of what that parent is insured for. Again, age is going to make a bit of a difference. These were adult children, but I'm just painting with a broad brush for everyone here to answer this question. So for adult children, it can look different, of course, if they're going to have policies where they have the policy on their body and they are the owner versus the policy is on their body, but the parent is still the owner. And again, it should be based off of the conversation about what do you think is an appropriate amount of premium on the child. So that's always the default answer, is that a properly structured whole life policy with a mutual company that pays dividends should be built, structured based off of the individual situation. But again, for folks that have that question about premiums and policies on children, the answer is if they are minors, let's just say up to half of the coverage that parents have, is what the children can have, and it's very common and even necessary to have all children insured at the same time, unless we can really convey the reason behind it's seeming that maybe one is favored above another one. It's like, you don't love that child the same as the other one. We got children's policies on each of our children, for example, all three of them at the same time. We were able to insure them up to half of what my wife and I are insured for, and things of that nature. But again, when you are talking about, like Pete was here, him looking at doing business with his sons, and then of course looking beyond having policies on himself and having policies on sons as well. Yep, I mean there's business interest right there. There's familial interest right there. That would be structured based off of that individual particular situation. And it would be a little bit different, of course, or maybe a lot different for everyone else. But that's a bit of feedback on policies on children, whether they're minors or adults, either way. So thank you, Pete, for that question. So this has been an absolute pleasure for me. If you have a question you would like me to address, feel free to put that in the comment section below or contact us directly with that question. And if you'd like to have a conversation about how to implement the infinite banking concept in your household or your business or your investing, then don't hesitate to reach out to us. And this has been a great pleasure for me. I look forward to our next conversation. Have a great day. Take care. Sean, losing my voice. No, I'm not. I'm fine. This is fine. I'm fine. Everything's fine. Was that good? I don't know. I got a question, Jesse. When's lunch? Seriously.